Thank you. Welcome to session 2. The focus of this session will be primarily economics in nature. The broad sort of title for this session is Developments in the Chinese and Japanese Economies, and we will try and sort of learn from the speakers what are the implications of economic development in these two countries for Southeast Asia. We have two very, very distinguished speakers, both from the point of in the research academic literature as well as in terms of policy making. On my right is Professor Danny Quah, right, from the London School of Economics, where he is currently the Professor of Economics and International Development. He also holds other positions like Director of the Sosri Hawk Southeast Asian Center, Institute of Global Affairs, London School of Economics. His previous appointments include teaching appointments at MIT and Harvard. He has also been played advisory roles in Malaysia, as well as in the UK on monetary policy. On my left-hand side is Dr. Naoki Yoshino, who is currently Dean of the Asian Development Bank Institute in Japan, as well as Professor Emeritus in Keio University. He has also he continues to publish very actively, if you check some of his latest publication. And in addition to that, he has served in an advisory capacity as well as membership in government committees on fiscal policy in Japan. Since there's a very severe time constraint, may I invite Professor Danny Quah to give his presentation first, followed by Dean Yoshino. Thank you.
Thank you, Cassie. Thank you, ladies and gentlemen, for the opportunity to get to speak to you on this question. There is a very simple, widely held, popular belief about the answers surrounding the topic of my lecture. When we talk about China's economic rebalancing, practically everyone now says, oh, China is in for a really rough ride, its growth is going to slow dramatically. We see sign after sign of that. That, for many people in this region, is quickly followed by the second plank of thinking on this topic. And that second plank is the following. We, the countries in Southeast Asia, are heavily export dependent. We grow from selling the things that we produce to other parts of the world. That theme continues. The widely held popular belief, correct, accurate, or otherwise, is that every single one of the Southeast Asian economies has a single largest trading partner. That single largest trading partner is China. So these two beliefs in conjunction lead to a scenario of general panic. This is because everything that we do to grow our economy in this part of the world comes from selling to China. China is set on slowing dramatically. We're in for rocky times ahead. When we hold this theme in our head, we get confirmation bias after confirmation bias. We walk around doing our daily business, we encounter other corporates, we encounter business people, we encounter friends, all of whom have a story to tell us. They know a business that deals with some company that all of a sudden is having to dramatically downsize. So the theme that then these ideas play out is that China's growth is set to slow. We're all in for rough times ahead. Southeast Asia's economic performance is in dramatic trouble. I want to use this lecture to dispute this theme. I want to use this lecture to uncover some facts that suggest that actually this popular belief is not as accurate as one might think. Okay. So let's explore what those facts might be. A first fact is yes, it is true that many countries in this region no longer have a traditional pattern of exports to the West. There used to be the view that the East, developing Asia, grew only because we exported to the West. That is no longer true, but it's been replaced by a similar belief. When we look at the facts, take Singapore to begin. Singapore, yes, it used to export mostly to the transatlantic powers, to the United States and Western Europe. No longer true. For the last 20 years, almost everything that we produce in this part of the world and in Singapore has been sent to other parts of developing Asia, has been sent to the East. China is part of that story, but it's not a huge part of that story. As of just a few years ago, Singapore today exports maybe 6 to 7 times more to developing Asia than it does to the traditional, conventional centers of the global economy, Western Europe or the United States. What is more dramatic might be something like Malaysia, more representative of many other countries throughout Southeast Asia, where, yes, a large part of the export success story is indeed the rest of developing Asia, but not just the rest of developing Asia, China in particular. So we're in trouble because observers have told us China is in trouble. Whether you read Larry Summers or the Economist newspaper or Martin Wolf, there's litany after litany of how the world economy might think it is recovering from the global financial crisis. And yes, indeed, some numbers somewhere do show that growth, the United States in particular, depending on who you read, the United Kingdom as well. But the rest of the world is in huge trouble, China especially so. So that popular belief does seem to be confirmed by things that we see around us. That popular belief, however, needs to be extended. And this is the first of the ways in which I want to try and push on our conventional understanding, because the facts that I want to establish turn on the following 4 themes. I want to argue that perhaps China, yes, it has slowed, but that should not mean general panic for Southeast Asia. But second, I want to dispute that China has slowed as dramatically as many people are predicting that it will. I want to look very quickly at long-term prospects for China. Is it heading into what the World Bank, the Asia Development Bank, and others think of as a middle-income trap? I want to argue that it is not heading in that direction, but then I want to unpack some of the more fervent beliefs that we hold when we cling on to that conventional wisdom. I want to look at the risks for China's economy in the short to medium term. And I want to come away suggesting that, yes, there are challenges and opportunities. Life would be boring indeed if the economic growth that you and I are going to confront in this part of the world was simply smooth sailing ahead. And yes, there are challenges, but there are also great opportunities. And on balance, I want to suggest that this belief that China's economic growth is headed for a decline and that therefore we should be panicking is a belief that we should discard. Okay. Well, when we push on this idea, we realize that the world has changed not just in the sense that we in Southeast Asia no longer export to the West, but instead we export east. Actually, most of the successful world no longer exports to the West, but exports east. Germany is a successful Western transatlantic economy. It is manufacturing intensive, its people are abstemious, it does not generate a huge set internal domestic demand. It has continued to grow throughout the global financial crisis, even with the collapse of the United States as an export market for Germany, with the collapse of the European Union around it as export markets for Germany. How did Germany continue to grow? It continued to grow because it was exporting to developing Asia and to China. The view that, that in Southeast Asia, we grow because we're now so reliant on China is a theme that is true even when we move away from Southeast Asia. It's true for all successful parts of the world now. And this was especially the case over the course of the global financial crisis when the United States, the United Kingdom, the transatlantic economies went in collapse. What allowed the world to grow was growth in China. Over the 5 years following the global financial crisis, that idea that the East or China or Asia grew only because the West imported was discarded time and time again. Over the 5 years following the global financial crisis, China grew by $4.5 trillion US, 3 times what the United States was able to do, even though as an economy, it's still less than half the size of the United States. It continued to show robustness and resilience, and we should have a little bit more confidence in how it did the last time and how we'll continue to do going forwards. Is China headed towards a middle income trap longer term? There are usually the 4 horsemen of the apocalypse that is drawn out when observers describe the possibilities for China's heading into a longer term middle income trap. That it has overinvested, its ratio of investment to GDP is in excess of 50% over long stretches of history. No economy has been able to sustain that. Well, that's true, but China is a developing economy. Its per capita capital stock, its per capita investment is still only 1/7 or 1/8 that of economies like Japan, Korea, or the United States. There's a lot of upside on its investment capacity. When we look at its housing stock, we are all familiar with the images of how China might have overinvested on housing, and that is one of the reasons it is headed for collapse. Well, actually, when you look at the quantity of empty housing units per capita, per person in China, that ratio is almost exactly the same ratio that you get for the United States. Yes, China has overinvested in some dimensions, but it is a large economy, it is a developing economy, and overall, there's still lots of room on the upside for its investment. When you pair that together with the fact that China is actually multiple economies, an East Coast that is overbuilt, overdeveloped, overcrowded, expensive, and a West Coast which holds 200 million people living on the edges of poverty, that's undercapitalized, that's extremely poor, transportation infrastructure is abysmal, the investment capacity remains high, and regional rebalancing is something that will continue to push China past the middle income trap. A third fact that people bring up when they say China is heading into the middle income trap is the demography fact, that China is rapidly seeing far fewer young workers, that there's a fear that China will grow old before it gets rich. 为富先老. Well, this might well be a problem. It's a problem that faces a lot of the world. But at the same time that we worry about China's old age pensioners, who are not, in the popular view, contributing to China's continued economic growth, we also have to remember that we worry also about domestic instability. And if I were a nation, I would be much more comfortable having 340 million old people practicing Tai Chi in the park than I would facing 100 million angry young men taking to the streets because they don't have jobs. A stable economy, an old economy, is a stable economy. Finally, the finance and debt issue in terms of these longer-term trends. This is a complicated issue because we realize that there's a large amount of local government debt outstanding, partly from China's having dealt with its fiscal expansion over the course of the global financial crisis. In principle, constitutionally, the national government is responsible for local government debt, but in practice, a lot of this local government debt has been outsourced to private individuals and corporates. And yes, there is a possibility of a financial overhang. We won't have time to completely unpack this issue, but I think it's useful here, again, not to get carried away with the panic scenario. And we need to be clear about a difference between liquidity and solvency. What China faces to do faces now in terms of its financial crisis, possible financial crisis, is a liquidity problem. But is it a solvent economy? Yes, it is. Short-term and medium-term, China's risks need not be Southeast Asia's risks. In the interest of time, let me expand on just one of these points. We all know the numbers. For over 30 years, China grew at excess of 10% a year. This year, it is probably going to grow at about 7.5% a year. Fears are that it will grow at around 7% a year for the next however many years. In the eyes of many, this is a dramatic change. It is a growth crash. Reality check. 10 years ago, the size of China's economy was a little in excess of $2 trillion US. That means that when China was growing at 12% a year, it was adding 0.29 trillion US dollars to its economy every year. This year, 2015, the size of China's economy is almost surely going to be in excess of 11 trillion US dollars. That means that when China today grows at 7% a year, it will be adding 0.8 trillion US dollars to the global economy each year. Put that another way, compared to 10 years ago, a growth rate of 7% a year today will add 3 times to China's economy, to the global economy, what a growth of 12% a year was doing 10 years ago. Okay. Second step of the reality check. If in Southeast Asia, compared to 10 years ago, the size of the economy now is double what it was 10 years ago, and that's an overestimate. That means that the capacity for our exporting to China today, even when it is growing at only 7% a year, is still 50% higher, proportional to our size, than it was 10 years ago. Even if China today slows down as dramatically as the worst forecasts suggest, it will still be a 50% larger opportunity proportionally for Southeast Asia than it was 10 years ago. Is Southeast Asia going to run out of export opportunities because of China's growth slowdown? Hardly. But even this 7%, even this 5 percentage point reduction in China's growth is probably an overestimate, and there are many reasons why that would be useful to unpack. I'm looking forward to doing that if there are questions on that. Let me conclude, since I'm out of time. What matters in terms of this theme, in terms of whether we in Southeast Asia will be able to continue to grow if China's slowdown does materialize, is something that matters hugely for us. I have told a story where when we look at the facts, yes, some of the facts support that hypothesis, but most of the numerical precision disputes that. Nonetheless, this is something hugely important for us to come to grips with. It's hugely important not just for us in Southeast Asia, but for the world more generally. The world's economic center used to be firmly mid-Atlantic. It is now racing towards us here in this time zone. It is this time zone that holds most of the world's population. If the world were a democracy, it is this part of the world that would make decisions about where the world heads. What I have told you about is a set of 4 ideas that suggest that the popular theme, that China's growth slowdown is going to be disastrous for Southeast Asia, is actually a theme that you and I need to discard now. Thank you very much.
Thank you, Danny.
I'd like to talk about the Japanese economy and its impact on Asian economy. And Prime Minister Abe came into power 2.5 years ago. Many people know three arrows by his monetary policy and fiscal policy and so on. The number one is inflation targeting of monetary policy. And second one is fiscal consolidation. And third one is growth strategy. So those are the three arrows of Abenomics. And since Prime Minister Abe came into power, the Japanese economy has drastically changed prior to several years ago. However, I would like to talk about the number three, third arrow is quite important, and monetary policy is much, much easier to start. So this is the Japanese fluctuations of the economy. As you can see from here, from year 2012, 13, 14, our economic recovery was very drastic compared to the past. And the transmission of monetary policy is very clear. Governor of Mr. Kuroda is targeting inflation for 2%. And he's announcing as long as 2% of inflation is achieved, he will keep on easing monetary policy. That has drastically changed, number three, expectations of general public. That is a very different policy prior to his governorship. And that has also depreciated Japanese yen because Japanese interest rate will keep on lowered and quantitative easing will keep on going. But at the same time, when Prime Minister Abe came into power, the US economy was not still stagnant, and Europe has faced with budget crisis. So the huge money came into Japan, and that has started to go back to their own country. And at the same time, Japan had started NISA, Nippon Individual Savings Account, which is a tax exemption up to 1 million yen for the individuals, and which accelerated the investment in stock market, together with overseas investors coming into Japanese stock market, which has boosted stock prices in Japan. However, in many Asian countries are dominated by banks, and capital market is very small. And as you can see in the middle, red portion is deposits, and pink portion is insurance and pensions. The middle part of Japan, you can see dark part is securities and stocks. So our capital market is very small compared to US, even compared to Germany. And many Asian countries are dominated by banking system. And why many people in Japan prefers deposits? Because principal guarantee, and it is very easy to withdraw money and make deposits, closeness and convenience. And at the same time, the Japanese mutual funds started to grow, but it didn't grow so much because the fees and commission systems of the distributors are based on fixed commissions and fees, rather than it is based on the performance of investors. That has discouraged the investors' performance to look at the mutual funds market. So in order to increase the capital market, participation into mutual funds and so on, I think fees and commission systems of distributors has to be changed in Japan. And that will be applicable to also in many Asian countries. And next is a demography. Japan is heading to all other countries. In near future, 1/3 of Japanese are over 65 years of age. This was the biggest problem of Japan, and it could not be solved by monetary policy. But many people thought monetary policy can recover Japanese economy. But we have to deal with demography. And most of that money was held by, you can see 60 years of age or 70 years of old. They have the richest assets. And they are mainly investing into deposits. and they cannot move into risky money. And that is another problem for Japan. So we have to solve this demography. That is very important. And if Asian economies are based on so much on banking systems, and that has also related to Japanese slow recovery of the economy. Basel capital requirement used to be set for 8% to all the countries. And however, based on my theoretical and empirical model, each country should have different capital requirement ratio rather than identical capital requirement ratio. And for example, in Japanese case, number one, rather than 8%, Japanese capital requirement ratio should have been 8 minus 2.20%. In the US case, just before the subprime loan crisis, capital requirement ratio should have been 8 plus 4.42%. And after the burst of the bubble of the US economy, it should have been lowered 8 minus 1.116%. And Canada is a very oligopolistic banking system, so Canadian capital requirement ratio is very close to 8%. The Japanese case was 8% was too high compared to other countries. And that has discouraged the banks to make loans to venture businesses and risky sectors. That has delayed the recovery of Japanese economy. So I think the Basel capital requirement should have been a little bit more cautious about country by country. And some of the new proposal was taken into Basel III. That is a counter-cyclical buffer. However, it should be much more advanced to make the capital requirement ratio should be different from country to country based on capital market economic structures. And the Japanese economy, from the economist's point of view, many Western economists are looking at LM curve is a monetary market, money market, is very important. However, Japanese economy was faced with a vertical IS curve, which means even if the interest rates were low, the investment will not be accelerated. And because of foreign direct investment from Japan to Asia, this IS curve is shifting from the right to the left. So easing monetary policy has a very limited role in still Japanese economy, and we need a growth strategy, third arrow, in order to make this IS curve to the downward sloping. Next topic is about the budget deficits, which is related to demography. Japanese budget deficits are the highest among all the countries. Greece, Italy, Portuguese, and so on. Greece is again facing with some crisis in their budget deficits, but Japan is much higher than Greece debt GDP ratio. Why Japan is still very calm, sustained, and Greece is always coming the problem? That is based on the demand for government bonds. In Japanese case, overseas investors are only 8%. So 92% of Japanese debt are held by domestic investors. On the other hand, Greece case, domestic investors hold only 23%, and more than 77% are invested by foreign investors. So that makes a big difference of the stability of the government bond market. And if it is based on foreign investors, they are very quick to move from Greece market to other markets. So interest rate, you can see here, has jumped very quickly. But Japanese case, most of the debt are held by domestic investors, so the interest rates were very stable. So in facing with demographic issues in Asia, I think to accumulate savings in their own countries and to finance to the debt in future will be very important. And also the budget deficits are coming from two main factors. One is social securities, and second one is central local government allocations, transfers from central government to local government. Those are the two on the right-hand side. about 1/3 of Japanese budget deficits are coming from social securities because of aging population. And then the transfer from central government to local government are another big factors. So if these two factors had been offsetted, then the Japanese budget deficits will not increase so much. So in many Asian countries facing with aging population, the budget deficits may increase unless they do several political policy reforms. And first one is pension funds. Pension asset allocation of pension funds will be very important. And 401k type of self-responsibility of asset allocation of pension funds will be very important. And at the same time, life insurance and insurance, growth of the insurance will be very important in order to finance its infrastructure investment and so on. And the third arrow of the growth strategy of Abenomics is about 8 or 9 points. One is increasing wage rates for the workers. And number 2, increase tax revenue. And number 3 is keeping zero interest rate policy and quantitative easing, and female participation in the labor market, and to encourage retired people, number 4, to keep on working in the market. Japan has a seniority wage system that discourages companies to keep retired old people on working. So Japan should change from seniority wage system to productivity-based wage rate so that old people can keep on working much longer. That is one of the key issues. And also female participation in the labor market will be very important. And sufficient funding for infrastructure financing, which is related to public-private partnership. And number 9 is SME financing. Small and medium-sized enterprises has to be very easy access to financial market. Last 2 points is related to the growth of the Asia. Asia is dominated by banking system. So, however, the banks are very much reluctant to make risky money because of Basel capital requirement. In Western countries, they have a thick capital market. So venture businesses, risky small businesses are very easy to access to the market. However, in Asian region, we have to develop some other channels to provide risky money into the growing sectors. That is, one is hometown investment trust funds. It is growing in Japan and Vietnam and Cambodia and Latin America in Peru. And those money, first it is financed to solar power and wind powers, and agriculture funding for new beans and small business financing. And those are coming from hometown investment trust funds collected from the individuals in the region. And they are providing money to those risky and venture businesses. I think not only bank deposits, but also community-typed crowdfunding, hometown investment trust funds will make the economy much more viable. And many old people in Japan want to develop their own region, and these hometown investment trust funds are growing in various cities in Japan. And the same method has started in Cambodia and Vietnam. And at the same time, the pension funds and insurance markets are very important. Especially self-protection of aging is life insurance. And that can also supply the long-term money into infrastructure investment. Lastly, the SME financing. This is a picture of large companies and small businesses. And this is a survey by Central Bank of Japan, whether they are easy to access to finance or not. Small businesses are always lower than large businesses. They have difficulty to finance and compared to large companies. The main reason is their accounts and accounting method is very, very false. And there's a joke in Japan, small businesses have 4 accounts. One is to show bankers, Second one is to show tax authority and his own account. And fourth account is to show to his wife. So this is very applicable to many Asian countries. So how to collect honest SME data and to analyze those data, and which make the good company of SME is much easier to finance. And this is the method we created in Japan to use a credit guarantee corporation. Many SMEs are borrowing money from financial institutions, but more than 90% of SMEs are using credit guarantee corporation. And if SME does not disclose honest data, then credit guarantee corporation will not provide guarantee to SMEs. And huge amount of data set had been collected. And then that allows us a very good statistical analysis. And this is one of the analysis of profitability, safety, efficiency, productivity, and growth potential. And these data set will allow SMEs, good SMEs, much easier access to finance. And same database analysis is provided to Thailand and other Asian countries. And I think the growth of SME is very important. And to analyze those data, and here the right-hand side is a very good SME, left-hand side is a very risky SMEs. Then good SMEs can access to finance much more easily. So the data analysis of SMEs will be also very important. And Thailand is now following this method, and Indonesia will follow too. And I hope that many Asian countries can have very good data set for SME. Thank you very much.
Thank you. Thank you. I will begin the post-presentation with a few sort of like minor questions, right? For Danny. They've done a lot of research on economic growth. And in the research literature, there's a lot of discussion about the role of technology innovation. What do you see in China today with regards to that aspect? I know you haven't covered that. There's been some discussion in the media and literature about the role of human capital, for example, that is, some predict that within the next 20 years, human capital will have a real significant impact in China. There's been also a lot of discussion, even looking at patent data, that Chinese R&D is really picking up. Can you kind of comment on that with regards to this? Yeah.
Okay. Thank you. Thank you for your question. What you're asking me to do is you're forcing our discussion into an area where economic understanding tells us is the true driver of economic growth in the long run. Okay. And the motivation for your question, as I understand it, is the view that says when we look out in the world, we see that economies can grow by a number of ways. The first obvious one is by building more machines, building more bridges, building more buildings, what in economics we think of as capital. And that is one way to allow an economy to grow. And it is a theme in economics that says that there are diminishing marginal returns to getting growth from capital, from an accumulation of capital. And that the true underlying engine of growth ought to be something other than just building more machines, building more buildings. And in economics, we call that technology. And so this view is one that says then for true growth that is sustainable in the long run, what we really need to do is to get our systems for producing new technology right. And what you are forcing us as a group to try and do is you're forcing us to divulge our views about the state of technological progress in China. Now, the truth of the matter is, while that's a very nice story that economists like to tell, we actually have very scanty direct evidence on what it is that drives economic growth in this way. Even the way in which technology is generated, the way in which we can measure how technology is generated has evolved relatively quickly. The way in which technological progress occurred in the early 20th century was by organizing large laboratories in Thomas Edison-type structures, putting people to work, forcing them to think hard, experiment with material products, and that's how we got new technologies. But of course, the way in which new technology is generated at the frontier today is something quite different. We sit around with teenagers who wear t-shirts and shorts, and we give them free Coke machines. We tell them to juggle and ride around on tricycles. And while they're doing that, be creative. Go out and write really inventive code for Google or Facebook or Microsoft. And that's how technical progress occurs now. So what you're trying to do is to get us from a very faulty understanding of how growth actually proceeds in practice, even though in theory we think we understand it, and apply that to China. And it will be a not unexpected outcome that says that we don't really understand. I mean, we think that China is behind the United States in its creativity, in how it is allowing people to be innovative. And then we hark back to how it is open systems of democracy that allow that technological progress to occur. That's a nice story. There's actually very little evidence that that story holds any kind of empirical credibility. What China is doing now is it's experimenting with parts of the technological space that the West has left unexplored. It is making huge strides in clean energy, in renewable technologies, in green technologies, so that very quickly it has leapfrogged to the frontier in these technologies. Will that be a sufficient engine for growth in the long run for China? Over and above the demography, the underinvestment, all of that, my suspicion is that for the next 30, 40 years, all of these more traditional, boring, conventional factors will still matter for China. It will still matter that we get capital in place. It will still matter that we do boring things like getting people to be able to do very staid work, and that the very ethereal, not so well-defined reaches of technology that are sexy, that are the kinds of things we want to think about today, will not be something that's relevant for China for the next 20, 30 years. And one of the reasons I say that is that that's exactly the same story that we used to tell about Singapore. You'll remember 25 years ago, Paul Krugman wrote a very famous article in Foreign Affairs called The Myth of East Asia's Miracle, where he argued the line that I basically just told, that Singapore and other parts of East Asia would not be able to grow unless we move to a model of technological innovation more akin to that in the West. Well, actually, Singapore today has a higher per capita GDP than the United States. The fact that Singapore has not moved to that system has not at all held it back from being able to progress. I think so too, China.
Thank you. That's a good insight. Dr. Yushin, you mentioned a lot of things about Abenomics. In terms of the sequencing timing, what is implemented? How long will it take to kick in? How do you see this kind of various policies impacting the Japanese economy in the next 1, 2, 3, 5 years? Which one will matter most? Which one we should keep an eye on and the impact will be felt?
First, I think the current Japanese economic recovery is very important. It comes from quantitative easing and easy monetary policy. However, it cannot boost Japanese economic growth. And as I mentioned, demography and aging problem is one of the biggest problems, which applies not only growth but also budget deficits. So I think the key issue is to utilize old people for labor force. Japanese retirement age was set in 1950, 55 years old. And at that time, many people, average life expectancy was 59. So they retired at 55 and they lived only 4 years. Now in Japan, many people retire 60 or 65. And Japan has the longest longevity in the world, 88, close to 90. Then it's impossible to sustain the Japanese budget because they are very healthy and they live very long. So I think to utilize the aged people into the workforce by changing the wage system from seniority wage system to productivity-based wage system. That is the key. And that cannot be handled by monetary policy. It requires structural reform.
Politically, it's possible to,
Politically,
implement this?
I think in Japanese survey says 80% of retired people wants to keep on working. And I think that is very good. And there's a joke by Japanese wife. All the Japanese wives prefer her husband will keep on working. Then there are reasons. And they said when he was working, she only prepared breakfast. And lunch and dinner, his husband ate outside. But once he retires, he doesn't know what to do. And also, she has to prepare 3 meals. So most of the people prefers people keep on working.
Thank you. We have a few questions posted through the pigeonhole. In terms of number of votes, I think the first one is clearly on China. I will read the question. Which Southeast Asian countries or countries will benefit most and least from China's economic rebalancing and why? So, Danny, can you?
Okay, so which will benefit most? Now, the different elements to China's rebalancing are actually useful to think about in trying to attack this question. Part of China's rebalancing is one that moves from external demand, foreign exports to domestic demand, having its domestic consumers take up more of the heavy burden. A second element in that rebalancing is simply a regional one, from east to west, from an overcrowded, overexpensive, overbuilt East Coast, where all the manufacturing industry is now, to an underdeveloped West, which is poorer at this point, poorer than most of Africa. And so that second element of rebalancing will be quite different from the first. A third important element of the rebalancing will be a move away, and this is something that all economies do, a move away from manufacturing, traditional assembly line manufacturing to more high value added service-oriented activity. So if we take just these three, and there are likely others, each of us in this room can think of yet others other ways in which China's rebalancing might occur. If we take just these three, then by far the greatest demand, I think, will be a demand for systems that take care of people. Systems that take care of older people, systems that take care of people who are, less fortunate, systems that you might think of as European social welfare-based systems for providing healthcare, childcare, medical care. Now, a lot of Southeast Asian economies are actually relatively well placed for that already. Medical tourism is a huge part of the economic landscape in Malaysia. Singapore right now, has a model of providing lower cost housing to, less advantaged parts of its population. As we look across the different parts of Southeast Asia, there are different parts of the industrial landscape in each of these that will slot naturally into China's rebalancing. So for my money, if I had to put just two items on the table, I would say figure out a system. We in Singapore need to figure out a system where we can export our expertise in providing low-cost housing, in taking care of the disadvantaged to the extent that we do. How do we transport that system to an economy like China's? If I were telling this story in Malaysia, I would say, look at our medical provision. How do we export that? Which in many instances is superior to that we see in the West. The chances of surviving cancer upon detection are much better in Malaysia than a similar patient in the United Kingdom. How do we export that to China as its rebalancing proceeds?
So this would basically be an outward FDI
I think, at this point, earlier there was discussion about how the the chain, the great change, the great global supply chain of production makes, concepts like FDI, direct imports, exports, a little bit tricky to work with. But yes, roughly that
Roughly
idea.
Thank you. Yeah, interesting. The second question is about Abenomics. I'll read it. Will Abenomics lead to large capital flows out of Southeast Asia and allow Japan to capitalize on the cheap yen? Who will benefit or suffer from the next stage of Abenomics?
I think as far as capital flow is concerned, in many Asian countries are still investing lots of money to Europe and United States. And capital flow among Asian countries are much less compared to flows from Asia to Western countries. And if the middle income class has been grown much, much further, then internal investment will increase much more. And furthermore, infrastructure investments are very scarce and needed in this region. So I think the building up of long-term savings, which is insurance and pension funds, that can cover the pension funds and retired people. And at the same time, the long-term capital will become a good financing source of infrastructure investment and long-term investment. So I think Asian region as a whole will be benefited by keeping the long-term financing within the region. That could enhance the mutual financial flows within the region. That could also become very strong against financial crisis, because financial crisis fits a lot to capital market. Then lots of money goes away and coming in. But if those are circulated among Asian countries, I think that will benefit all these regions.
But will the market work in such a way that when you have Abenomics, you have the question asked, the capital flow from Southeast Asia into Japan?
Yeah, into Japan, and
Yes.
also among Southeast Asian countries, and also that from Japan to Southeast Asia. So mutual capital flows will be enhanced,
Okay,
and that will stabilize the capital market.
okay, thank you.
Can I speak to that as well? I mean, the immediate impact of the first arrow of Abenomics is cheap money, is low interest rates. And that in the very, very immediate short term, as we saw for the United States when it was practicing quantitative easing much more than it is now, is going to be a flow of capital out of Japan into the Southeast Asian economies. It is instead the reverse, the unwinding of Abenomics, if we do ever get to that stage, when Japan has to undergo its own version of tapering, that we will need to be watchful for the large capital outflow from the rest of Southeast Asia. For right now, I think things look pretty good for Southeast Asia in terms of that dimension.
Okay, thank you. I think we will have, it's actually time is up, but I will use my discretion to maybe get 2 questions from the floor. If you can identify yourself and be very, very brief. Any takers? Or you're more keen on lunch? No? With that, I think I will close the session. If you have any additional questions, you can actually talk to Professor Koh or Professor Nashino. Thank you.